Think you're smarter than the market? So does everyone else. And that's exactly why most investors fail to beat it. Today, we're exposing the truth about underperformance and what you can do to stay ahead. The shocking stats. What you need to know. Most investors are not underperforming by a little. They're dramatically underperforming. The S&P 500 has returned approximately 10% historically, but retail investors often earn just 4 to 6% annually, sometimes less. Why? Lack of consistency, emotional decision-making, trying to time the market instead of staying in it. Dalbar's quantitative analysis of investor behavior report repeatedly shows that average investors underperform because they chase trends, panic sell, and make knee-jerk reactions. Key insight: even missing the 10 best trading days in a 20-year period can cut returns by half. Emotional decisions. What happens? Investors buy high when hype is loud, e.g. during bull markets, and sell low during corrections or crashes. Why? Emotions like fear, greed, and FOMO, fear of missing out. Examples: meme stocks, AMC, GameStop, pumped by hype, crashed COVID-19 market crash panic selling in March 2020. Markets rebounded within months. Cognitive biases that ruin portfolios. Recency bias. Thinking recent events will repeat forever. Herd mentality. Following what everyone else is doing. Overconfidence. Thinking you can beat the market consistently. Lesson: emotions plus money equals dangerous combination without a plan. Timing the market versus time in the market. Myth: I'll just buy low and sell high. Reality: timing the market sounds smart, but it rarely works. Why? No one knows when highs or lows will happen until after the fact. Why long-term wins? The market is volatile in the short term, but trends upward over decades. Missing a few of the best days often occurs because those days follow the worst. Better strategy: stay invested. Use dollar-cost averaging, investing a fixed amount regularly, to ride the ups and downs safely. The tools most don't use. Retail investors often ignore tools that pros use to manage risk and boost long-term gains. Key tools: diversification. Don't put all your eggs in one stock or sector. ETFs and index funds. Lower cost, broad exposure, and reduce individual stock risk. Asset allocation. Adjust risk exposure based on your age, goals, and risk tolerance. Why this matters: a portfolio of 10 hot tech stocks isn't diversified. Age 25? You can afford more growth risk. Age 60? You need preservation. Tip: rebalance your portfolio regularly to stay aligned with your strategy. How to beat the average investor. It's not about being a genius. It's about discipline. Simple strategies. Automate your investments. Set recurring investments so you don't think emotionally. Ignore the noise. Headlines and hype rarely help long-term decisions. Track net worth and progress, not just daily returns. Investors who succeed long-term often do less, not more. They stay the course. Where most go wrong in 2025. In modern times, new mistakes show up. 2025 investor risks. Blindly chasing AI stocks without fundamentals. Overreacting to rate hikes, inflation news, or political turmoil, relying on influencers or TikTok trends over real research. Modern traps. Shiny object syndrome, always looking for next big thing. Short-term dopamine. Trading for excitement, not strategy. Lesson: fundamentals still matter, even in a fast-changing world. Why underperformance happens: emotions, poor timing, lack of strategy. How to fix it: long-term thinking, automation, diversification, education. Golden rule: you don't need to be smarter than the market. You just need to be more disciplined than most investors.